Hi, this is Andy Hoffman, Marketing Director of Miles Franklin Precious Metals in our 26-year business. It's midday, Monday, June 29, 2015, and today's special audio blog is titled Fiat Currency in One Short Phrase, We All Live or We All Die. Well, all I can say is this. For months now, in what has seemed like an eternity, I have dutifully posted content every day, often multiple pieces, amidst the most information-deficient journalistic environment of my 26-year career. Due to the lazy, bubble-induced psychosis induced by history's most unrelenting, overbearing money-printing, market manipulation, and propaganda scheme, not just here in the United States of corruption, but everywhere, the mainstream media all but died. No better exemplified than the NASDAQ topping its 2000 bubble top, while CNBC simultaneously achieved all-time low viewership, dating back to when it went on air in the early 1990s. Meanwhile, the global economy has collapsed to its lowest level in generations, while social and geopolitical unrest rapidly mounted, as evidenced by referendums I predicted in Revenge of the People in Scotland, Catalonia, Spain, and Switzerland. Frankly, even Zero Hedge, by far the top agglomerator of relevant financial news, was having trouble finding actual news content, and this with a dedicated team of global internet browsers and a massive network of people sending it local content from around the world. Yet, here at the Miles Franklin blog, we found new and creative ways to present the aforementioned, accelerating, global, political, economic, and social train wreck in real time, knowing full well the end game of fiat currency collapse was rapidly approaching. Well, said endgame appears to have arrived, and the Miles Franklin blog is stronger than ever, here to help you through what could be an extremely difficult time, no matter where you live, what you do for a living, and who you count as friends, relatives, and colleagues. To that end, I have been so overwhelmed by this weekend's news flow and associated commentary, I can barely keep my head from exploding, as evidenced by the fact that, at the gym this morning alone, in just an hour's time, I amassed more than 2 pages of notes in my little gray book, just watching from the moronic headlines crossing CNBC's scroll, and the equally idiotic commentary from the so-called experts trotted out to proclaim all's well, just as Kevin Bacon did in Animal House before being trampled by the panicked crowds. Why do I focus on CNBC so much, you ask? For good reasons. Perhaps as valuable as any we can discuss regarding actual financial and economic content. To wit, an article I read this weekend titled CNBC, the Electronic Shaman in the Casino, in which it describes CNBC as, quote, serving an indispensable shamanistic function, providing a kind of ideological placebo that calms everyone down by offering a series of comforting myths. In other words, as they aptly noted, it is the perfect fascist combination of government and big business, serving the role of 1984's Ministry of Truth and V for Vendetta's Voice of London, by proliferating propaganda, minor mistruths, and flat-out lies to calm a panicked world, replete with so-called experts with track records that would get them fired in any other business, and likely sued into oblivion. No one more so, by the way, than the Federal Reserve itself, as well as its minion bankers, politicians, and overseas central banking peers. To that end, this morning's relentless parade of quotes from Wall Street strategists, economists, and analysts, all of whom have been unequivocally wrong about essentially everything, who nearly collusively reanimated what will clearly be summer 2015's new, unrelenting propaganda buzzword of how markets will eventually rebound as Greece has been appropriately ring-fenced, making the odds of a global contagion like 2008 highly unlikely. To wit, I urge everyone to Google, "How could the Greek experts be so wrong?" posted on Zero Hedge this morning. In it, you'll see a series of positive quotes on the Greek outlook over the past 2 years, including, heck, last week, of the very same people CNBC regularly trots out as resident experts, as opposed to people like David Scheckman, Bill Holter, and myself, who have been as right as could be about Greece and everything else from aside from historically manipulated markets for the past decade and a half. Featured in the article, aside from Wall Street geniuses like J.P. Morgan's Thomas Lee, famous for predicting huge, imminent stock gains in, I kid you not, August 2008, to newsletter dunces like Dennis Gartman, famous for being wrong about, well, everything, to Mario Draghi himself, who as we speak is learning that whatever it takes isn't actually good enough. However, no quote captures the lunacy, idiocy, and ineptitude of the so-called powers that be better than the May 2014 famous last words of Jean-Claude Juncker, the then and still president of the European Union, after hoodwinked investors purchased Greek 5-year bonds for 4.95%. Quote, I say to all those who bet against Greece and against Europe, you lost and Greece won. You lost and Europe won. Well, this morning, Greek 5-year bonds are trading at nearly 23% yields, en route to infinity, as when the clock strikes midnight tomorrow night, that is Tuesday night, they will have officially defaulted on 1.8 billion euros of debt, en route to defaulting on perhaps the entirety of Greece's nearly 400 billion euros of debt, most of which is owed to the ECB, the IMF, and a broad swath of European banking institutions. Which is why it's so comical that Juncker is practically begging Greeks this morning to vote yes on next Monday's referendum, which frankly is all but moot at this point, given that not only will tomorrow's default deadline have already passed, but the Troika itself shot down the very bailout proposal the referendum was set to address. Unquestionably, the powers that be will do everything in their power to, quote, legitimize said referendum as a Greek vote on whether or not to stay within the euro. However, with no capital, no bailout proposal, and no will to move forward, the Grexit we guaranteed 2 years ago is now as imminent as it is inevitable. And LOL, I just read that the Greek government doesn't even have enough money to conduct the referendum, even if there was actually something of substance to vote on. And scarier still, of which the title of today's very special audioblog was gleaned, was Juncker's twin comments of stupidity and terror. The former in claiming Europe is in better shape to withstand the withdrawal of a small country than ever, although with said 400 billion euros of debt, most of it owed to entities that couldn't possibly cover the losses, including the ECB itself, which has less equity capital than is owed to it by insolvent Greek banks. There's nothing small about Greece, let alone the ramifications of a Greek default and euro currency exit. And as for the latter, get ready to hear a quote that just surpassed Bernanke's subprime crisis is contained and Draghi's whatever it takes comments for the most insanely ominous political statements ever made. I.e., Juncker's belief that Greece will remain within the Eurozone as either we all win or we all lose. In fact, as I write, Juncker just revealed his spiritual side as well, in asking, Greeks not to, quote, commit suicide just because you fear death. This is a career, carnival-barking bureaucrat saying this, one no less, with as much responsibility for the Greek financial tragedy as anyone on the planet. And as for all winning or losing, a new definition of losing will need to be created for what's about to happen, with Greece being the least of it when the entire global fiat currency regime implodes. I'll get back to the turmoiling, extraordinarily ominous global financial markets in a second. But first, the hard facts of exactly what's going on in Greece, and per the title of Thursday's audioblog, how it affects us. To start, this weekend's complete collapse of discussions between the Troika, i.e. the ECB, IMF, and European Union, and Greece, in which the subject of this weekend's article, Stop the Presses, the big one may arrive July 5th, was essentially rendered moot. In other words, with no new bailout proposal to vote on, what's the point of the referendum at all? As noted above, the powers that be are desperately trying to spin it as an opportunity to right the ship, as if they could just possibly come up with a new proposal by tomorrow's default deadline, giving them a few more days to plot and plan a way to stave off the inevitable. Given how far apart the parties are, I'd put the odds of a new proposal at close to zero. However, like trap rats on a sinking ship, they'll try anything to kick the can a few more feet. And by the way, we're now at midday Monday. Actually, the day's over in Greece, and they haven't even had a meeting. You see, the best case scenario, which I put in quotes from the powers that be, is that the utter carnage Greece is experiencing today will scare the Greeks into voting for anything that will dull the pain, even if it means another economy and sovereignty killing bailout, which ultimately will result in the same exact fate a few months from now. Again, I'd put the odds of such a scenario occurring at close to zero. But hey, with global central banks, PPTs, exchange stabilization funds, and the gold cartel working in concert to calm markets with unprecedented manipulation, as they are doing as I write, I guess hope does in fact spring eternal, with the world's 1%. Regarding Greece, its banks have been closed until at least the July 5th referendum, whether or not it actually occurs, whilst its stock market has also been closed. Not that it prevented the Greek stock market ETF from falling more than 15% this morning, and what I long ago deemed the world's most important stock, the National Bank of Greece, ticker NBG, trading more than 30% lower to an all-time low of 80 cents per share. Meanwhile, the Greek 10-year yield has surged from 11% Friday afternoon to more than 15% this morning, whilst the other European PIGS yields have similarly exploded. And as for what's going on the ground, Greek ATMs essentially ran out of money, and no doubt the people are as panicked as at any time since the Greek financial crisis commenced 5 years ago. And the contagion Washington and Wall Street act so confident cannot happen, those very same experts noted above, is irrespective a reality. And not just in Europe, where PIGS sovereign bonds and bank stocks are leading a dramatic financial market decline. Yahoo Finance and other MSM propaganda outlets are desperately attempting to provide said shamanistic hope by suggesting America is, quote, distanced enough from Greece to avoid disaster, and intimating that this Friday's comically fraudulent NFP employment report will be just as important as the collapse of Europe. Also, trumpeting comments from European leaders how they will use everything at their disposal to calm markets. Like covertly buying stocks and bonds, and naked shorting silver and gold. Then again, at what point do people realize, en masse, that the very same strategy, i.e. July 2012's whatever it takes, has so miserably failed that just 3 years later, Europe's debt, unemployment, and unrest have exploded, whilst its economy, currency, political stability have plunged, calling to question its ability to even maintain a financial union. Meanwhile, in the thrall of this weekend's catastrophic Greek events, the fact that for the first time since the middle of the 2008 crisis, the People's Bank of China lowered interest rates and bank reserve requirements on Saturday was ignored. This following the hellacious 19% plunge in the Shanghai Stock Exchange bubble over the past 2 weeks. The Shanghai Exchange opened 3% higher, but ended more than 3% lower, as officially the world's largest equity bubble has now morphed into a bear market. Frankly, there aren't words to describe how cataclysmic the bursting of China's economic miracle will be in the coming years, when amidst an acceleration of the worst global depression since the 1930s, the massive leverage built up at the behest of its clueless central bank and communist government implodes, spreading its massive deflationary tentacles throughout the world and subsequently engendering the most globally coordinated hyperinflationary monetary policy in history. And then you have Puerto Rico, the quasi-American state we have long guaranteed to collapse, sending massive financial losses from its quasi-American citizens to actual Americans like us. Of which I pose the following question. How many of you believe it a coincidence that less than 24 hours following news that Greece is short of default on its own massive debts, Puerto Rico's governor claimed the ramshackle tourism island's $72 billion of debt is, quote, not payable, and that there is, quote, no other option but default or severe restructuring, which, by the way, defines a default. In other words, as we have shouted at the top of our lungs, and as Jean-Sebastian Juncker inferred when stating either we all win or we all lose, the second one hopelessly indebted nation defaults, whether purposefully or, as in Greece's case, because they have no viable alternatives, all other hopelessly indebted nations will demand the same. As the old saws claim, misery loves company, but more importantly is the time-honored human survival trait of safety in numbers. In other words, no one wants to be the only nation to disgrace itself, especially if it means its plight will be dramatically worse than the rest. Which is exactly why the current Greek tragedy, which mathematically must eventually play out everywhere else, is so intense. However, if all nations believe they will be in it together, or as Juncker aptly puts it, they all die together, such a solution is far more politically and socially acceptable, which is no different than the reason why Wall Street managers are happy to all be long when the market crashes, as they were in 2008, as opposed to risking greater gains but potentially cataclysmic losses unshared by others by being the lone short wolf. Hence, what I wrote above of CNBC, whose job is to rationalize the investing of other people's money in bubbles, as opposed to acknowledging the ugly truth of historic bubble valuations. Which in turn brings us back to why I spend so much time focusing on the manipulation of markets, from treasury bonds to make sure history's largest debt load is serviceable, to oil and copper to create a perception of economic strength, to currencies to try and make nations' respective manufacturing sectors more competitive, to, of course, the two most important indicators of all, the Dow Jones Propaganda Average and precious metals, which I long ago predicted to be the last to go markets, given the certainty the powers that be would do everything in their power to prevent these respective economic and monetary barometers from telling the truth of where the world stands. Not to mention that in the former case, massive stock losses, like those occurring in China as we speak, cause the so-called wealth effects said powers that be erroneously believe will save the economy to vanish like a fart in the wind. I mean, let's again consider China. We're at the peak 2 weeks ago. 2 weeks ago. The Shanghai Exchange was up an incredible 148% from last August, which is just 10 months ago, when the PBOC commenced its maniacal easy money policy. Over that time, Chinese economic growth collapsed to a 35-year low, commodities of all types plunged to 2008 or lower lows, and even Chinese housing prices, where roughly 3/4 of Chinese household wealth is held, fell essentially every month. Not to mention the plunge in Chinese exports and utter implosion of Chinese imports. Whilst, what do you know, not only did Chinese physical gold deliveries rocket to an all-time high, but the Chinese government confirmed its intention to establish a yuan-based gold fix by year-end. Heck, even MSM lackey Bloomberg published an article this weekend titled, "Chinese Gold Standard Could Create Fireworks," which I'll simply leave to your collective imaginations. In other words, the PBOC managed to create an historic equity bubble while the Chinese and global economy collapsed. So just think what will happen now that Chinese stocks are plummeting in internet tech wreck style, backed by an incredible $370 billion of margin debt, much of it held by housewives and taxi drivers in the incredible 5 million new margin accounts opened in the last 6 months. In other words, it's no coincidence the Chinese press, controlled entirely by its government, claim today that a market crash would pose a great danger to social stability. Which is no different than what's going on here in the States, or Europe, Japan, or the rest of the world. In other words, governments could not be more fearful of what a stock crash would engender, as given the horrific global economy to start with, record low political approval ratings, and central banks void of any remaining ammunition or public confidence. Now that they've bloated their balance sheets and taken interest rates to 0 or below, there will likely be no way to right the ship once it starts listing. Which is exactly why market-sensitive confidence metrics in China will undoubtedly crash this week, and why, if the Fed and its minions can't arrest the stock collapse here, the same will happen in the United States of supposed recovery, which, given already horrific spending, saving, and investment demand, could cause a 2008-like deer-in-headlights scenario by the end of the summer, if not sooner. And don't forget that commodities, on average, were at or below their early 2009 lows before the Greek and Chinese sagas started, and that commodity sales are by far the world's largest business. Notwithstanding blatant oil PPT efforts, commodities are again falling sharply this morning, and at this pace it won't take much for the CRB Commodity Index to fall the final 6% to its early 2009 low, yielding a cataclysmic cycle of selling that could take out entire nations and the currencies that back them, such as, for instance, the powerful BRICS like Brazil, Russia, and South Africa, all of whose currencies have already plunged to all-time lows. Back to the U.S. Is it me, or does the street still comically believe the Fed will, quote, lift off interest rates in September? Or perhaps on July 29th, thanks to last month's comically fraudulent NFP employment report, which not only contradicted all other employment indicators, but all economic indicators of all kinds. No, my friends, the Fed never intended to raise rates, nor could they, given the massive debts held by everyone from individuals to corporations, institutions, sovereign nations, like the US for instance, and oh yeah, the Fed itself, with history's largest fixed income portfolio, totaling $4.5 trillion of Fed-printed money that will ultimately be the responsible of US taxpayers. Remember, bond novices, Rising interest rates means falling bond prices, and giving the duration trap the Fed created by eschewing its historic focus on short-term bonds and taking on far more price-sensitive long-term bonds, even the slightest increase in interest rates will utterly destroy them, and America itself. Not to mention a federal government with $18 trillion of largely short-term debt that needs to be continuously rolled over. In other words, the list of things that could go wrong, both here and overseas, has never been longer. And now that the Greek crisis has restarted, the mathematical inevitability is, quite conceivably, equally imminent. Which is why the potential for a Grexit, i.e., a Greek euro exit and debt default, despite all parties believing it could be avoided, is not only likely, but now the most likely scenario. And why, to that end, the comexident we wrote of last week, of the cartel losing control of its blatant precious metal suppression, not to mention countless other market manipulations, is as real a near-term possibility as at any time since 2008, when amidst the most transparently obvious naked shorting scheme on record, in the hope of directing safe haven flows from gold and silver to treasury bonds, the cartel inadvertently created a massive supply shortage. Premiums for the little available metal, which on average had multi-month delivery delays, rocketed to the moon, including up to 100% for physical silver. And this time around, with inventories of both metals significantly lower, global physical demand dramatically higher, the mining industry decimated by a decade-long lack of capital and new developments, and plunging commodity prices, which will only exacerbate the horrific supply trend, it's all but certain new shortages will develop, albeit far more dire and irreversible. In fact, as I watched the cartel do their thing this morning in the New York and London paper markets, I looked at one of the largest bullion dealers' websites to see they were essentially sold out of junk silver, or as I deem it, the ultimate fear asset, which all precious metal holders must hold at least a small amount of in case the worst case scenario evolves. For the measly 2 bags they still had in inventory this morning, not the large $1,000 face bags, but the smaller $500 face bags, they were trading at premiums of $4 to $5 over spot prices, compared to perhaps $2 to $2.50 over spot a few weeks ago. Heck, maybe last week. In other words, whilst paper silver prices have been relentlessly suppressed, real physical prices have surged by $2 an ounce or more, just as they did in 2008. Which, by the way, is why I sold all my remaining paper PM investments 4 years ago in lieu of physical metal, which I knew would be nearly impossible to hold down when the inevitable big one arrived, which apparently could be now. Just ask the Germans, who this morning, according to anecdotal evidence, are clearing out local coin dealers like a supermarket before a hurricane. As for said markets, as I write at roughly noon Eastern Standard Time, you can imagine the US PPT came flying in to try to save the day. As always, in fact, when I read yesterday afternoon that early Dow futures indications suggested a 300-point down opening, I muttered to myself it will probably be closer to 200 by the time the market opens, care of the PPT. And wouldn't you know it, when the New York Stock Exchange opened at 9:30 a.m. Eastern Standard Time, Dow futures were, I kid you not, down exactly 177 points, or exactly the 1.0% PPT limit down level I've discussed for years. As for gold, at that same moment yesterday afternoon, I said to myself, gold would only be allowed to open 1.0% higher, i.e. the cartel's limit up level on 99% of trading days. And what do you know, gold opened exactly 1.0% higher before it and silver were hit by the 104th Sunday night sentiment raid of the past 106 weekends, followed by the 464th 2:15 a.m. Eastern Standard Time raid, i.e. when the London paper pre-market opens, of the past 529 trading days when both metals had recaptured their Asia opening highs. And of course, additional smashes at exactly the 9:30 a.m. Eastern Standard Time New York Stock Exchange open, when simultaneously the Dow magically surged, and of course the 10 o'clock a.m. Eastern Standard Time key attack time number 1, when global physical markets close. That said, both metals are proving extremely resilient as I write, with paper gold up $4 and paper silver down marginally, while stocks are again falling sharply. LOL, the Dow is down 190 points, Wilt's major European indices are down 3 to 3.5%, and PIG's indices much lower, as are commodities across the board and the yields of major Western sovereign nations. Wilt's PIG's and other emerging market sovereign yields explode higher. And how about that? The dollar is actually unchanged against the euro and down against other non-commodity currencies like the yen. Yet again, proving that as weak as the euro is, and believe me, it will get weaker, the dollar's horrifying financial status is by no means a safe haven. Also, by the way, proving that the ECB is doing whatever it takes this morning by massively buying up euros to try to make it seem like Greece is okay. Look, I could not have been more vehement or correct in my predictions dating 18 months back that the dollar would rise against nearly all global commodities as the endgame commences, due to the same liquidity vacuum as occurred in 2008, which for all intents and purposes is occurring as we speak, other than the specific case of today's dollar-euro and dollar-yen crosses, with the average currency down 40% against the dollar since 2011 and 90% for the 4 BRICS nations whose currencies are not pegged to the dollar. And as for the European endgame nears its end, particularly for the euro in its current form, said dollar-euro exchange rate will only become more volatile and wacky as countless alternative scenarios are considered, from 25 new currencies to a good euro featuring stronger players and a weak one featuring others, to new currency blocks featuring other Eastern and Western players, and perhaps even a gold standard. That said, the one thing we are sure of is that as the crisis expands, the purchasing power of the dollar and all fiat currencies will collapse against precious metals, initially in the physical markets and eventually in the paper markets when the New York gold pool, as I affectionately call the cartel, collapses. And if the worst case scenario eventually does occur, by the way, there may no longer even be a paper market, which would make it all but impossible for bullion dealers like Miles Franklin to exist. In other words, you better get it while you still can. To boot, at prices well below the industry's cost of both current production and long-term sustainability, as when the big one expresses itself in its full glory, the only place you'll be able to find it, at substantially higher prices from substantially less reputable sources, will be the black market that will inevitably develop. Here at Miles Franklin, where we have conducted business for 26 years without a single registered complaint, we can help you not only with the purchase, sale, or storage of precious metals, but a variety of financial planning strategies we have honed over 2 decades of working with gold and silver. To that end, all we ask is that you give us a call at 800-822-8080 and allow our staff of professionals, on average sporting nearly 25 years of industry experience, to give you a free consultation. And as always, I can be reached via email at ahoffman@milesfranklin.com. And on a final note, I figured I'd rehash a quote from my must-read April 2013 article, Greek Tragedy, which barely 2 years later appears more likely than ever to live up to the moniker I gave it at the time as my top pick for most likely to catalyze the big one, i.e., I have zero doubt that, one way or the other, Greece will eventually exit the Eurozone, potentially providing the flashpoint catalyzing the end of the Western banking system, and with it financial Armageddon. Thank you very much.